Welcome back. I'm Jeremy Szafron. Now, we have three developments hitting the U.S. economy at the same time, and each one matters to the markets. Now, first, funding stress is back. Bloomberg reports overnight repo rates for the year-end turn have jumped about 60 basis points above the Fed's target. Now, several major banks are now openly asking the Federal Reserve to step in with new liquidity. Second, political pressure on the Fed just escalated. In an interview transcript released today, President Trump said lowering interest rates is now a, quote, litmus test for his next Fed chair. And Kevin Hassett, widely viewed as the frontrunner for that job, said today that there is plenty of room to cut rates even more than a quarter of a point. And third, the labor market is cooling once you look at the details. Now, job openings ticked up. Yeah, they did. But hiring fell by more than 200,000 and layoffs rose to their highest level since early 2023. And quit rate, that dropped to its lowest since 2020. And the inflation data the Fed needs for tomorrow's meeting won't be released until July. Meanwhile, markets do expect a rate cut tomorrow. Japan may raise rates next week, and metals are responding. Gold holding above $4,200. Silver, if you look at that chart, just pushed past $60 US for the first time ever in history on the spot side. Now, this is not positioning. It's not hedging. Markets are adjusting to what they believe comes next. And few people explain these shifts, the history, the credit cycles, the politics, with more clarity than our guest today. James Grant joins me now. He is the founder and editor of Grant's Interest Rate Observer. And for more than 4 decades, his writing has challenged central bank orthodoxy, warned against the distortions of easy money, and documented how these markets behave when interest rates lose their meaning. Jim, great to have you back on Kitco News. Nice to see you.
Thank you. Nice to be here.
Obviously, not too much going on in the news flow today.
Nope. Quiet.
I want to start with this new report on repo rates. It's trading at around 4.25, 4.25, roughly 60 basis points above the Fed's target, and major banks are calling for intervention. Now, in your latest letter, you wrote that today's financial system suffers from what you call, quote, suppressed price discovery, where official rates conceal the true cost of money. Is this repo spike simply the real price breaking through the official storyline? And historically, I mean, 99, 2011, 2019, these were technical events. They were early warnings that the system was kind of over leveraged and under reserved. Is that what we're looking at now, Jim?
Yes. Under reserved is certainly a term of art. The Fed speaks, the Fed can speak in tongues. Nobody can quite understand what they're talking about. There's an ample level of reserves. And that's what the Fed now says it wants. There is an abundant level of reserves, what it has had. A couple of years ago, it began with the target of abundant. And previously, back in days of yore, there was an adequate level of reserves. Nothing, not too big, not too little. So what does all that mean? It means that the Fed is, in fact, the puppet master of the money markets. Mm-hmm. And it administers these rates, and the trouble, many of them administer. So the trouble with administered rates is that they return so little information to the administrator. Right? So the Fed, in that sense, encounters the problems of any central planner. And these problems were last and most vividly on display in 2019, September 2019. One day, out of the blue, no press release, no brass band announcing anything, the overnight rate on a collateralized loan, collateralized by Treasury securities, jumped from like 2% to about 10. It didn't stay there long. It was just, but it stayed there long enough to send shockwaves of astonishment and fear through the institution of our central bank.
Right.
And the Fed intervened with a great injection of money, which we kind of euphemistically called liquidity. Printed up some dollars, and the Fed then was kind of noodling over how to present this to the world, because it had just not so long before this, it had begun to to tighten up his balance sheet. He wanted to put the financial crisis and its aftermath behind it. Mm-hmm. And lo and behold, the market revealed that there were cracks and rivets popping, and there wasn't enough liquidity in the market. Right. Although in 2019, the Fed had every reason to believe that it was perfectly adequate, this level of reserves. Okay, so they didn't know, they couldn't know, they thought they knew. Realizing that there were not enough dollar bills floating about the system, the Fed undertook to inject about $60 billion a month, I think, if memory serves, which it so infrequently does, but $60 billion or so a month, beginning in September. And by the time, let me add that it looked like QE, didn't it? All this $60 billion. And the Fed, in intimate conversation among the members of the Federal Open Market Committee, said, "God, it does kind of seem like more QE. That's not good. But how do we sell this?" And they sold it as a temporary technical fix for a problem of reserve provisioning. Yeah. That sounds like an anodyne thing, right? So, and then Jay Powell gets up and says, "This is not QE. In no sense is it QE." But 6 months later, the Fed had added $350 billion plus to its balance sheet. And that took us to March of 2020, when the coronavirus manifested itself to all and sundry to see and to suffer from. So that was the those 6 months were the entree to the complete sense of abandonment of monetary discipline, and monetary discipline was thrown to the side to combat the pandemic. Anyway, it's a very long-winded way of saying that the year-end difficulties we're having in the money market now, and the calls for help on the part of the big banks, could be the prelude to a turn in the Fed's operating procedures, such that we are once again adding liquidity rather than pretending to withdraw it or to keep it the same. And getting back to the reason that we're all here talking together today is because that would be good for gold, I'm sure. I
gold, and Jim, maybe silver too. Okay, well,
I always forget the high achiever.
You know it.
Yeah.
Okay, well, I want to ask you something about what you just said there, and then, of course, we'll get onto the macro thesis. That 2019 episode, that 10% overnight rate on Treasury-backed lending was a reminder that even the safest collateral could become, temporarily unfinanceable. Are we closer to repeat of that dynamic now? In other words, is today's rate move, the market quietly warning us that system is running without enough true liquidity once again?
We'll know more after the turn of the year. But yes, I think that is the message of the market. I think it's the message that the Fed will take from the market.
Right. That
what the market wants is more liquidity.
Right.
And I'm of the view. This is very much a minority opinion, but I'm of the view that a little volatility, a little bit of illiquidity is great, because it rations lending, and it constitutes a reminder that the public credit is in trouble by the immensity of the public debt. And when you hear the Fed talking about these episodes of illiquidity in the money markets, they say everything except that the supply of securities is greater than the demand for securities at current levels of interest, current rates of interest. That to me is the clear takeaway is that the supply of securities is greater than the demand at these rates of interest. So that means that we're perhaps ought not to be running a 7% or 6.5% deficit as a percentage of GDP at a time of roaring financial prosperity, if not universal prosperity, in the main street. Mm-hmm. So it's a kind of a fraught and a hugely interesting moment.
Yeah, absolutely. And of course, we're watching the Fed's expectation and the rate cuts tomorrow. The market has already priced in a rate cut, as you know. But the October-November inflation reports, they won't be out until January. And this entire year has been defined by revisions, jobs, inflation, GDP. The numbers kept getting rewritten. If policymakers cut without current inflation data, is the decision grounded in economics anymore, or is it just driven by funding stress or even political influence?
I think political stress, political influence, and funding stress both play their part. The Fed has three statutory mandates: full employment, stable prices, and moderate long-term rates of interest. That's the Fed's legislative marching order. Yeah. But there is a fourth, and it's the quiet one, and it is the mandate, we may conjecture, to maintain so-called smooth market functioning. And that can take precedence. The Fed is in the business of facilitating the financing of the public debt as much as it is in doing the other things I mentioned that Congress has charged it with undertaking. So this gets really interesting. So let's say that the rate of inflation is running hotter than the quite stale data that we're looking at, and the Fed has loosens and cuts rates, and then they've really got a problem.
Yeah, Jim, when you describe smooth market functioning is the quiet, the Fed's quiet kind of fourth mandate, it raises a critical point. If the central bank sees every sign of stress as a threat to market functioning, haven't we conditioned Wall Street to just expect this rescue, reflexively? In other words, is the fourth mandate the very thing that prevents genuine price discovery?
I think that we are talking among like two guys who really can read each other's minds.
Yeah. Good.
It's like watching Fox and Friends. Don't you think that President Trump is the greatest guy? Yeah, the greatest one.
Well,
so yes, I exactly agree with you that this is the process of conditioning the markets to expect the Fed to do what the Fed has habitually done, which is to make things nice and to tamp down volatility. The volatility of the bond market is very sedate. The so-called move index is low, at low levels. That's the comparison. It's the counterpart to the VIX index in fixed income. And so the bond market is kind of serene, notwithstanding what's going on in the money markets, and we know about the stock market. So I think you're exactly correct that the Fed is and not for the first time by any means. The Fed is leading people to think that nothing really bad is going to happen as long as it's in business.
So, obviously the defense is that in a $30 trillion treasury market, disorder, isn't just noise. It can spill into mortgages and corporate credit and payrolls. Do you see a world where the Fed can step back from this fourth mandate, or is intervention now kind of baked into the architecture of the system?
Scott Besson said something I thought was very hopeful and very sound, and sound as I would judge sound. He said the Fed ought to be less with us. It ought not to be so much at the center of the financial markets. It's like a World Series baseball game beginning with a 10-minute feature on the umpires. Where they went to high school and what their parents had to say about them, only nice things. So the umpire is not really the point of a baseball game, nor are members of the FOMC really the point of functioning financial markets. They're there for a purpose, but not the purpose of control, it seems to me. So can we back away from this? Yeah, we can. We have to tell people what's going to happen. That from now on, we're not going to hold the hand on the market. We're going to take the trading wheels off and let the market have its bumps and Band-Aids. It can buy its own Band-Aids, and if it has to go to the emergency room, well, I don't know. The analogy is getting strained, but the Fed, I think, certainly in the spirit of Secretary Bessent's call for simplicity, might add to that the allied good of letting the market go its way, and even as So President Trump is saying, well, this business, the great Hollywood mega merger. I'm not so sure about that. And when he saw the latest 60 Minutes, he was really not sure about it because he didn't like the way he was portrayed by that person of low IQ. So he said, I'm really not sure about this. So is that the way it works? Is every price to be determined by a lobbyist who knows somebody who knows somebody who knows somebody who knows the president of the United States or who knows the chairman of the Fed? This is really kind of crony capitalism.
Let me ask you, because you mentioned Scott Bessent's view that the Fed should quite literally do less, step back from constant intervention and stop trying to manage every fluctuation. If the Fed actually adopted that posture, what would the markets look like? Would we finally get real risk-taking again, or would the adjustment be so severe that the Fed would never tolerate the pain long enough for discipline to return?
Well, that's a matter for the Fed to deal with. If that time ever came, you'd want somebody who was committed to the principle of markets rather than the principle of the outcome. And the trouble with the interventionists who are more and more in control of our economic lives, they're not free market people. They're business people who want to do deals and control outcomes, whether it's a financial market outcome that is up and to the right in the chart pattern, or whether it's getting a golden share of a steel company in a merger, or getting 25% of NVIDIA's sales of a certain chip to China. Where did this come from? It is more and more looking like Argentina before the ouster of the Peronistas. I don't know. It's quite concerning to me where we're going. Mm-hmm. This must be the least conservative Republican administration on record. Certainly, it's the most venal. By which I mean the most self-interestedly interested in money for itself.
Critics obviously would say that the modern system can't handle hands-off Fed, between the leverage now and this derivative plumbing, and then we got the political pressure. Is the minimalist central bank even possible anymore, or is that era gone?
Sure, yeah. Send me in, coach. I'd do it.
You've got your hand up.
Of course, it's possible. You'd have to resolve to not watch TV for a day or two if you're running the Fed and just let chips fall. But the alternative is to let things proceed as they have been proceeding, and to if a sparrow falls to earth, to return that bird to the air. To never let anything get. Never let a bear market proceed too far.
Yeah,
and. So excesses accumulate, and misallocations build on each other, and pretty soon you have a dysfunctional economy. And that's the reason. Recessions exist for a reason, and bear markets exist for a reason. It's not just the glib business about returning money to its rightful owner. These downturns and these slumps and these recessions clear out mistakes, investment mistakes. and they're not pretty, but they are necessary. And to forestall them through constant liquidity injections is to sentence us all collectively to an economy that is increasingly rigid and incapable of correcting its errors.
Itself.
Not good.
Yeah. I mean, Jim, that raises a bigger question about where all this liquidity ultimately shows up, because while the Fed grapples with funding strains and political pressure, the stock market today is, I mean, it's being held up by an extremely narrow group of companies, and almost all of them, that strength traces back to the AI theme. And I'm not sure if you heard, we had a new report out today. We have Howard Marks warning about a terrifying, what he's calling a terrifying mismatch in AI financing, and NVIDIA alone carrying an outsized share of the market's gains. Let me ask you this. I mean, does this AI-driven leadership strike you as a healthy expression of innovation in this market, or is it another symptom of what you were just talking about, of a market distorted by cheap money and Fed intervention?
Yeah. It reminds me of the late 1990s and the overbuilding of the infrastructure of the internet. But it's so, in that sense, it is a normal cyclical excess. Technology brings with it enthusiasm. Enthusiasm becomes over enthusiasm, and at length there is a reckoning, and most often, or not infrequently, at least a crash. That's the record from railroads, and I dare say it was a record in canals, and before that, record in what preceded canals. I'll think of this about midnight. But there is something else going on, and that is the competition to push money onto the projectors and the promoters of data centers. And we at Grants liken them to the pyramids of ancient Egypt. Great money pits. And as a friend of mine would remark at times like this laconically, he'd say, "Well, no more in 10 years."
Yeah,
which is true, but not helpful, right?
Not helpful, but it is interesting, because that same report from Howard Marks, I mean, they put out that note, and he raised that massive red flag regarding the duration mismatch of this AI arms race. I mean, he questions the sanity of buying 30-year bonds to fund technology that changes every 18 months. I mean, are we effectively financing future junk, where these multi-billion-dollar data centers become stranded assets long before the debt is ever repaid, leaving investors holding the bag, I guess, on what could be a massive infrastructure bubble?
Well, only the very best questions answer themselves, and you just did it. Yeah, that's exactly right. Yeah. So Howard Marks is right, and you're right in framing Howard Marks's remarks, and I couldn't have said it better, nor will I try.
Yeah. Okay. Interesting. He did describe, I mean, I found it just an interesting kind of note. I mean, he described the employment outlook as terrifying, warning of social division and populist demagoguery, which we've seen. But this ignores the massive deflationary pressure that AI puts on goods and services. I mean, if AI drives the cost of living down faster than it displaces wage, we aren't heading for poverty. We're heading for that new era. What are your thoughts on this?
That's if it works.
Yeah.
Right? Is it really the thing? I don't know. Is this, does it think, or does it grab phrases from copyrighted materials and put them together most cleverly, and thereby save our college students from the unfair and excessive effort required by professors to have them write something original? I don't know. I don't want to be the guy standing by the road laughing at the Model T that is waiting for a tow out of the ditch and, say, getting a horse. But I think that there are real questions about the efficacy of this technology, about its usefulness, and the compulsion to lend, the compulsion to finance, is just as you and Howard have intimated. It is separate and distinct from, I think, from a fair reckoning of the usefulness and the lifespan of this technology. This technology generally, as Fred Hickey was always reminding us, technology is in the business of destroying itself, through something better, and so it ought not to be priced as if it were, some product coming out of Procter and Gamble. It would have a 30-year shelf life, product life. So I think there's much to be worried about in this very, very top-heavy market. I was talking with Simon Mikhailovich, who is somebody that certainly Kitco would warm to. Simon is in the physical gold business. He buys it for his clients, and he stockpiles it and keeps them apprised of why they own it. And he was reminding me, and I will remind our audience, that it's not just the stock market that is kind of suspended on, as it were, on a single line of dental floss. It's the economy itself is very dependent upon the top 10%.
Yeah.
For consumption, it's for taxes. It's and if the stock market were one morning to get up and walk in front of a bus, as stock markets tend to do when valued as high as this one, although very few, if any, has ever been valued so high as this, the economy, I think, would be in rugged shape. So I don't know. This is the age-old conundrum about human progress. There's always the progress is intoxicating. Railroads were intoxicating, and you have 3 or 4 lines of track we build in parallel fashion, and they all get financed, and only one would work, and it didn't matter. People were just caught up in the excitement of the moment, the excitement of the vision of the technology, and the hope for something better in the future. And how much more so with a thinking machine,
Yeah, no kidding. Something definitely to think about. I mean, this brings us also to private credit. I mean, I'm sure you heard about Jeffrey Gundlach. He said earlier this week that private credit, $1.7 trillion market, is engaging in garbage lending. You've heard that from most people, with echoes of kind of 2006. Now, the ACC says deployment hit a record $592 billion last year. In your recent letter, you warned that today's markets operate in an era of false calm, right? Created by low rates, as we're discussing. Is private credit one liquidity event away from discovering what these loans are really worth?
No. The private credit has instituted ways to forestall any such revelation. It's got something called LMEs, liquidity management exercises. This very, very kind of anodyne and a little bit suspicious name given to the process by which bankruptcy can be avoided, or bankruptcy can be avoided by displacing one set of creditors to the advantage of another set, and thereby postponing some day of reckoning. Collateral can be shifted around, and it's all if you ask me, it's all quite cynical, and is in contravention of the very notion of credit, which is man's confidence in man. It's faith. Credit is confidence and faith, and so private credit is increasingly functioning, as I say, in contravention of that dictum, and it is also subject to very, very worrying tendencies towards kind of false ratings. There are a bunch of rating agencies that you haven't heard of unless you're in the business, and they are joining and giving these issuers of debt kind of a very pretty-looking ratings given the financial situation of those borrowers. So there's great inflation in the ratings of private credit. There is opacity. You can't know exactly often what you're investing in. Disclosure is minimal, often, mostly, and And as again, there's this compulsion to lend, all of which is a competition to lend, this regulatory arbitrage. So credit, since time out of mind, has worked in cyclical fashion. It begins with after a bust, and everyone's contrite and resolved not to do that again. The market is hungover and is never going to take another drink. Then time passes, and people take a little bit risk. That's good. That risk felt good. It pays, And at length, we're back to where we were before the last crisis, and it was ever thus. It's ever that way now, and I think we're rather towards the end, the beginning of this particular credit cycle, towards the explosive phase, but who knows when.
Yeah. Timing is everything. I want to put...
No, it's not. If it were, I wouldn't be talking with you.
Yeah, it's true. It's true. It's actually, good to say.
It's
Jim, let me put kind of a contradictory development on the table. It was just today, Goldman Sachs CFO Dennis Coleman, he came out with a story and he said that private equity deal pipeline is finally thawing. Sponsor-led deals are up 40%, jumbo financings are percolating, and M&A on track for one of the biggest years in history. Now, this is happening in the same market where, Jeffrey Gundlach says private credit resembles subprime, and where you've warned that low rate distortions haven't been reflected in asset prices yet. So, which signal should investors trust? Is it this revival in deal making as a sign of genuine health, or the last grasp of a market kind of trying to do business before funding costs and credit losses make that impossible?
Yeah, good question. As to the facts, to begin with, private credit is inherently speculative grade because it is almost always extended to the participants in some sort of highly leveraged transaction, mostly private equity. So almost by definition, private credit is speculative grade. So it's not, Jeffrey didn't say anything too revelatory in calling it junk. It is inherently junky. But, the veil is so closely guarded against too close inspection of the merchandise in private credit. You don't really get the marks to market. You don't get them at all. In fact, this stuff is not traded. I guess maybe some of it might be, but mostly it is untraded. So there's not that fail-safe on where you stand. And the ratings are questionable often.
Right.
So I take Jeffrey's side in this. And, you think that it can't go on. It does go on. And that, too, is always the case. My goodness, these cycles, if they ended where they ought to end, use that in quotation marks, ought to.
Yeah.
Life would be so much simpler. But as it is, they test the patience of the most devoted exponents of the value investing creed. These go on, and they want you to jump in and participate. I won't do it.
Talk about being, mispriced for safety. I mean, you've warned for years about the loop between private equity, private credit, and life insurers, and how risk, migrated into institutions people assume are safe. Gundlach did say that private credit has two prices, 100 or 0. If that's true, even in part, is this eventually an insurance sector crisis?
Yes. Yeah, I'm glad you mentioned that. We have been, as far as I know, we have very little company in this, but the risks that private equity and private credit present to the life insurance policyholder and annuitant, we think are considerable. And we've been working on this thesis, building it, and naming names. I won't name them on air because that's why the subscribers subscribe. But we think this could be the epicenter, or certainly close to the epicenter of the next major credit crisis, life insurance.
Interesting.
And it's going to be too bad for the people who didn't think they were getting involved in speculative activity when they took out a life insurance policy. But policyholders might well be drawn into the troubles. And of all the vulnerable people in the world, people depending on life insurance premiums ought not to be unknowing participants in the speculation. Everyone ought to be offered the opportunity to speculate, but I think none of us ought to be drawn into such a thing without full disclosure, which has not been forthcoming.
That's interesting. I mean, obviously, insurers would say, we're matched, we're capitalized. But are they capitalized for a world where price discovery returns?
No. They're capitalized for prosperity. Let's put it that way. They're not capitalized for adversity. Long ago, in the Bible of Value Investing, entitled Security Analysis by Benjamin Graham and David L. Dodd, first edition, 1934. And the authors wrote. This is in the aftermath of the official ending of the Great Depression. Wrote that that bonds ought to be able to stand a depression test. And of course, that we don't have depressions anymore. We have recessions. We have recessions that are foreshortened by Fed intervention, but there's no Federal Reserve for the life insurance business. These life companies, I think, are not capitalized for real trouble. Yeah. Their assets are not necessarily acquired with real trouble in mind. I think it's an understatement, right?
So on
plainly.
Timing,
I think, let me say it more plain. So the asset allocators of the insurance companies are not saying, let us buy loans, private equity, private credit loans, leverage loans, and BAA's corporate bonds that stand the test of a severe cyclical downturn. Nope, I don't think that's the way. They buy them because they need to fill a spot in the portfolio with a certain yield level, a certain expected return, and those are investment habits that are ingrained by years and years of Fed intervention and by low interest rates, as we were discussing earlier.
Yeah. And Jim, I got to ask you, if the insurance sector is where the mispriced risk is concentrated, does that mean the average retirement account is more exposed than people realize? And I guess, further to that, we could kind of get into that regulatory thing, right? Because unlike banks, insurers operate under a completely different regulatory framework, but state regulators often assume that these private loans will be held to maturity at par. Does that blind spot create a situation where the problems don't surface on balance sheets until they're unavoidable?
Yes. The possibility of an life insurance centered financial problem does put retirees at risk. And yes, the regulatory regime of life companies is state by state, with varying degrees of attention, rigor, and competence. So, just as you say, or implied with your question, it's this is going to be, we at Grants think it's a problem. It's going to be a bigger problem. But we've been wrong before. But we're trying to build this thesis and build it out as helpfully as possible to our readers.
Yeah, interesting. I want to pivot to kind of overseas for a moment, because markets now price an 80% chance that the Bank of Japan raises rates next week. Now, in your recent letter, you wrote that time is returning to finance, meaning duration matters again after years of zero rates. If Japan tightens and the yen strengthens, the carry trade obviously unwinds. Cheap yen has fueled U.S. tech treasuries and the credit for a decade. Could that unwind trigger a global margin call that a Fed cannot offset?
Yes. And the guest for your next show, this guy works in Singapore. His name is David Dredge. And he's been writing about this, and he's actually a participant in the markets, writing about it for years. But David, and we are of one mind on this, that there is a genuine risk that of repatriation of funds by Japanese investors who have spent years sending their money abroad, scouring the globe for higher yields than those available in essentially a zero interest rate regime, Japan. And the Japanese 10-year note is near 2%. The 30-year bond, I guess I saw it's a 3.5, something like that. So these are now respectable, almost competitive yield levels worldwide. So it's one of the risks that the market is confronting, whether we acknowledge it or not. Yes.
Yeah. Yeah. I mean, the consensus is that the Bank of Japan will move slowly and the market is kind of prepared. What makes this potentially sharper than expected, do you think? A little bit more.
Well, let me again agree with you. I've done nothing but agree with you, which is very pleasant.
It's not good. It's not looking good here, Jim.
No, wait. Ladies, I've not been fed these questions. Please know that. But Japan is a great volatility muffler. Just when you think something dramatic is going to happen, the authorities will issue a press release so bland and absolutely impenetrable as to meaning that, and the market will say, I guess that's so. What is going to happen? So this particular rock has been rolling down the hill of people who expect to get that rock to the top of the hill over and over again for many, many years. So there's no guarantee this time will be the Bank of Japan won't somehow pull how's this for a mixed metaphor? Pull the rock from the. It could be this winds up as a great big nothing. There's no repatriation. There's no problem. But rarely have Japanese rates been. Well, they haven't been seen this way for a generation at these levels. So we'll see if there's a repatriation trade, and if there is, what consequences it might have. But there is the risk of a very damaging repatriation trade.
Yeah, well said. And listen, Jim, our time is going too fast. I know you have a hard stop. Before we let you go, because it is Kitco, and I do have to ask you, otherwise our viewers won't be happy. I mean, gold is above $4,200. Silver just made that new all-time high, over $60. I mean, you've called gold the, quote, reciprocal of faith in central banking, right? I mean, silver has always been the public's metal. Do you think silver's surge is, a broader public vote of no confidence in monetary policy here?
So silver is interesting. So there were a pair of books that came out in the early '80s, and one was Gold. It was entitled "Gold: The Golden Constant." The Golden Constant. It was Roy Jastram, I think. And Roy Jastram wrote a second book, a companion book, Silver: The Restless Metal. And I smile when I think of the title, The Restless Metal, because silver is just crazy, right? It's not restless. It's nuts. It is the most volatile thing. It's as volatile as Bitcoin. It's as volatile as it's as volatile as Donald Trump. I'll put it that way. It is not strictly a monetary metal. It is also an industrial one. And what silver has going for it now is some element of appeal to those who believe that the so-called debasement trade is live, well, and kicking and going higher, and it also is the market for those who detect a great supply-demand imbalance. Mm-hmm. And want to capitalize on that. So there's a supply deficit in silver. There is a monetary element, and it's a very volatile thing. Now, there's a bit of folklore in the metals markets that says gold peaks when silver finally has its day in every cycle. So when silver catches a bid, that's it for gold.
Yeah.
And I think that is not the case now, because silver is not really on a speculative bender. It's on a supply-demand bender. I say this there's a little hesitancy because, you never know until the aftermath what is speculative and what is a more or less healthy market move.
Yeah.
But certainly, gold has exhibited none of the hallmarks of extreme speculation. Certainly not in the western portion of the world. ETF flows, what have you, are nothing like what you'd see in a culmination of a speculative move. So so silver is a thing, and so is gold. Yeah.
James Grant is the founder of Grant's Interest Rate Observer. Thank you for joining us today. This was very insightful. Obviously, our time went too fast, but we got to get you back on, James, and I appreciate your time.
I would like that. Thank you. So long.
Thank you. Appreciate that. All right. For continued coverage of gold markets and global policy shifts, make sure you're subscribed to Kitco News and follow us across all platforms. I'm Jeremy Szafron. Thanks for watching.